we're just about 5 hours away from that 8 p.m. deadline that President Trump set when it comes to Iran. And of course, you think about what he posted on social media this morning. Obviously, the stakes are very high. You wouldn't know it by looking at the markets right now. You certainly wouldn't know it by looking at the 10-year Treasury yield, pretty much flat on the day. I wonder what you make of this sort of non-action when it comes to the bond market and markets overall.
So I'd say a couple of things. First of all, thanks for having me on, by the way. I'd say a couple of things. First of all, markets, the level of uncertainty is extraordinary. You know, being active in the markets and trading in the markets today, particularly more so in the equity market today, the depth of the markets is incredibly shallow. When you go to execute something, you see how the market moves. There's not a lot of certainty. And so the markets tend to, particularly in the rates market today, it is, you know, rates have backed up a decent amount. I agree with the commentator before who said front end of the yield curve in the U.S. I think is interesting. And, you know, now that you're certainly not pricing in anything in the way of cuts. So, you know, it's a period of stasis. I will say one thing. People watched that rally you saw in the equity market last week. The technicals in the equity market are phenomenal. The earnings growth dynamics are still very good. And so if you had good news, market would rally significantly. The problem is you just don't know how or when. And so today, you know, there's a lot of sitting on people's hands, and you see that in the depth of the markets as being incredibly shallow.
Well, I'm curious. I mean, you mentioned what we saw in the equity markets, a big rally, relief rally going through last week. It feels like you haven't seen that same dip-buying impulse, or at least not to the same degree when it comes to the bond market, particularly the Treasury market. I wonder whether, you know, you're watching this sell-off and you think about where rates are right now and whether that presents as a buying opportunity to you.
So, you know, today I think the front end is well priced, and I think, quite frankly, I'm in a mode today of staying conservative until you get more data. You know, I'd say we're pretty good investors at markets that are predictable, or you know, when you anticipate and can use your data to analyze what the oncoming situation looks like. This is pretty unpredictable, and you talk about when you move prices of major commodities around with the speed at which you're doing. Pretty hard to do that. And it's pretty hard, quite frankly, when you have such a range of outcomes in oil prices and the commensurate impact on inflation to say, gosh, I'm really going to drive into the rates market today. That's a pretty bad answer in terms of, but it is what it is today. The front end of the yield curve and the carry you gets you, you know, you feel very comfortable with, there's a Fed that's not going to raise, or the new Fed, or however you interpret it, not going to raise rates. I think ultimately, and I think the commentator before said, you know, you've got a labor situation that's quite different. The starting point of where rates are, you have room to be accommodative. So listen, the amount of carry we create in our funds, particularly keeping our duration in the front to belly of the curve, you know, this is one of those periods, you know, you just want to see, like, can we keep our portfolio stable, carry well through it, and then we're going to get more visibility on what the environmental condition is, and then you could lean into some risk a bit more.
I am curious, though, about as we start to get data on that condition, Rick, and just a few moments ago, Bloomberg just had an interview with Kristalina Georgieva over at the IMF, who said that next week, when they do release their outlook, they will be downgrading the global growth forecast. Now, that shouldn't be a surprise to anyone, but I am curious about your view as to what the U.S. growth forecast could potentially look like, given the general perception about our energy independence and some degree of insulation, some degree from what's happening overseas.
Yeah, I mean, you know, it's a pretty incredible thing. Like, we live in a world, people want one word or one line answers to things and say, gosh, the economy's going to slow. When you actually break down the data and you get really deep into what the economy really looks like, if you go back a month or so ago, the acceleration of the economy, we're talking about mid to high 5% nominal GDP, and you've got a fiscal tailwind that's quite significant this year. So now you say, okay, we're probably going to create some slowdown on the other side of this, obviously given the impact on fuel prices, the impact that it has tangentially on consumer goods, et cetera. So now you say, okay, I would say if I was operating at mid to high fives, gosh, we've gone through the numbers. Can you move that down 0.5% or so? I think so, but that's very far from, gosh, we're in a crisis. When you still got an economy growing at those sort of levels. I was looking at something today, my partner Russ Kostrich was looking at, that actually, if you go since February, there are more earnings revisions up than down. So you think about, like, you got a pretty good environment. And so, what's really hard is you got to step back and say, okay, environmental condition is good, the economic condition is good, the corporate condition is quite good. You've got obviously a shock to the system that you've got to build into your model. That's tricky.
And to Russ's point, I mean, we've seen a lot of that data tracked here at Bloomberg as well as over at FactSec and others, showing that increase, the actually increase that we've seen over the last few weeks in expectations for earnings growth. Is there an issue, though, and I know it's hard to sort of trade around as an investor, but is there an issue about waning confidence, where some of the enthusiasm we had for deal making in the investment banking space or corporations looking to expand and invest, does that now potentially become at risk?
Yeah, I think your point's well taken. At the margin, you think about M&A, you think about CapEx and scale, and by the way, how you finance that. Listen, when you have this sort of disruption and this sort of uncertainty on a global basis, trade flows that are more difficult to interpret, there's no doubt you create this cloud over the system that does bring some of that back in terms of it does dull some of that enthusiasm. I will say today, we see it in the markets. People are literally, I looked last week at flows, a lot of money coming into cash. By the way, we're still seeing good flows into our income funds, et cetera. But people are sitting back and waiting and being conservative. But there's no doubt, as you say, a little bit of confidence is pulled back. I will say one thing I've learned about human psychology, things can change pretty quickly. If there is obviously an avenue which the data improves or the environmental condition improves, if that happens, boy, it will be pretty fast in terms of how people will jump in. Given like I say, the backdrop is pretty good generally.
Well, to your point on cash, I'm taking a look at money market fund assets right now. We're sitting at about $7.8 trillion, which is truly remarkable. We'll see how that changes as we get closer to tax day. But, in thinking about the economy, I want to talk a little bit about the bind that the Federal Reserve is in because, obviously they're trying to thread the needle between what we're seeing on inflation and what we're seeing when it comes to the labor market. We did get a labor market report on Friday. Markets were closed. It was a little bit unusual, but we saw a lot of strength come through. Certainly you saw big revisions, but still that headline number really surpassing expectations. And from where you're sitting right now, Rick, I wonder what you see as the bigger issue in the Fed's mind at this moment. Is it the inflation side of things, the risk that, we could see some stubbornness there, or is it still the labor market?
Listen, I think every central bank is going to have at the forefront of their thinking, how do you deal with inflation, particularly when inflation is elevated today. And we've come from a place where it's been hard to reduce that sticky level of inflation. If you said to me, what is the bigger structural problem? I think it's employment. And like you say, it was a pretty good employment report. But I've actually looked at the revisions you said, the income data, the work week data, and then if you take it in the context of the last 3 months, 6 months, there was, and by the way, there's weather effects, there were strike effects. So I think you need to look at the broad landscape. The broad landscape is, you see this from companies, I'm going to look at every day. If you cut your labor force by 20%, your operating leverage into your earnings is profound. I was looking at 2 companies yesterday, and you realize how powerful that is. Companies are going to operate more efficiently. To me, the bigger issue for the Fed is how do we create maximum employment? There's no question it's a supply factor, but immigration is something that can change. There's a structural dynamic at play. So how do you balance these? My sense is what the Fed will do, we'll wait. And we'll say, let's get more data, We've got obviously counteracting forces, and let's wait. The thing that's important for a rates market, we live in a global world, and if you look, Bank of Australia, Bank of Canada, the ECB, the Bank of England, Bank of Japan, globally rates are going, they're moving rates higher to combat the inflation. So it is something obviously that's got to be at the forefront of the Fed's thinking, where I think the employment one is a bigger one, but I'm not sure that the Fed would interpret it the same way today.
Well, Rick, to your point, the Fed operates in a global environment. Their peers around the world are raising interest rates. I hear what you're saying that, you don't think necessarily that's something that the Fed would do. What different ingredients would you need to see where you would say, okay, this is a conversation worth seriously having at this point?
For raising?
Yes.
Listen, I think you'd have to see a persistent structural level of inflation that worked its way in the system. And quite frankly, I don't think, 3% is not at the Fed's 2% target, but I don't think 3% is an infectious, and you look at five-year forwards, boy, they're not really moving. So the system, you're not seeing a spike in inflationary expectations, certainly longer term. If you started to see that, and if you start to see, gosh, there's a persistence to this interpretation of inflation, you start to see the two-year forwards, the five-year forwards really start to move. Then I'd say, if you're at the Fed, do you start to react to that? I think so. One man's opinion is a very different reaction function to a supply shock versus a demand shock when you talk about inflation. At the same time, people are getting pressured by higher food prices, fuel prices, to raise mortgage rates, to compound the problem. Just doesn't strike me as the right policy initiative. But listen, if you start to see an infectious increase in forward inflationary expectations, listen, that has to be part of the calculus for sure.
Rick, I do want to get your thoughts on credit markets right now, both as a signal with regards to the geopolitical risk out there, but also within the context of some of the issues that have been raised with regards, I guess from a liquidity standpoint, at least with regards to private credit.
So I tell you, the one thing that's been super impressive is the credit markets are extremely resilient. And I will say, we've done some managing of the risk in our portfolios, and us and I'm sure others have built a lot of cash in a portfolio to get through what is a risky period. The credit markets, the high yield market, which I think is natural to some extent, but it's been pretty resilient relative to what's happening in private credit. And as yields have backed up, you've brought in buyers, insurance companies, pension funds. So not only have spreads held in, now you've had real buyers and you've had real transmission in terms of supply that's coming on the market in size, particularly in the investment grade market. It's been really impressive. And if you take the whole cacophony of risk that's come into the system, it has been amazingly impressive. I will say there are days that I would like it to push out a bit more than it's moved out, but credit markets are very relaxed. And they're saying, let's get back to the point. There's so much cash waiting to go, particularly for rates and for people that have liabilities you're trying to match.
Yeah.
There's so much money out there to go in. It is impressive.
Well, on that point then, because obviously we have a lot of big issuance coming down the pike, particularly with regards to data center build-outs and things of potentially $14 billion, maybe potentially over the next couple of weeks. Is there, you don't have any real concerns right now about the market being able to absorb all of that new issuance?
I just came out of a meeting. Listen, I mean, so the answer is no. I think the market will be able to absorb it. I think that is going to be the ecosystem of growth in the economy. I think a lot of particularly hyperscalers are in. We just went through some of the data around it. They're in great shape from a leverage point of view. And by the way, some of these are new names that will come to the market. So no, I think it will get. Assuming we're making an assumption on the next 24 hours or the next 2 weeks, in terms of what the geopolitical looks like, but I am pretty blown away by how much money's out there. I will say, from my perspective, some of the issuance that's coming in some of the bigger names that actually comes at very tight levels. Mm-hmm. I don't find from a return perspective they're not that interesting. I actually find some that are coming in equity or ones that are maybe a little bit earlier stage that are pricing to the upside potential. Those I think are a bit more interesting today. That's
really interesting. So basically what you're saying is when it comes to some of the issuance that we're seeing, it sounds like particularly when it comes to the AI, the data center build out, that maybe the better place to kind of play that, so to speak, is in the equity market rather than, buying into some of these new issues.
Katie, I will say this for my whole career. I actually think investing in technology is better in equities. Now, the upside is greater. Oftentimes, you end up, and by the way, this is part of we talk about with regard to private credit. You think about what your recovery is on debt and equity in technology. They become pretty equivalent numbers. But the upside potential is significantly greater. So I would say generally, I prefer equity. Now, there's also converts. There's loans with warrants to the upside. There's some ways to play that. And, nothing is digital. There's some financing in tech that we've done that is pretty interesting. But I would say generally, I tend to prefer in technology to be in the equity side because the upside is much greater.
And Rick, we only have about a minute left with you, but I do want to quickly talk through some of your holdings when it comes to bank, because I see that U.S. high yield makes up nearly 15% of the portfolio. You were talking about, of course, corporate credit. You said that it's been remarkably resilient here. And certainly when it comes to high yield spreads, they've actually come in over the past couple of weeks. I wonder, how you think that sort of stands up when it comes to a valuation perspective. I mean, would you go as far as saying it looks a little bit expensive right now?
Yes. So by the way, we have reduced a decent amount of our European high yield as well as some U.S. high yield. There's also some tools we use where you can overwrite some of your positions to create more income against your existing positions. So we've reduced a decent amount of it, particularly in Europe. And by the way, a decent amount of European investment grade credit. It's just not that interesting in terms of where the levels are today. Versus, the securitization market, particularly things you could do that are more customized, et cetera. Some of the, we've moved some money into mortgages, not so much recently. EM, it's all in the world of being a bit conservative today, but EM, the yields are attractive, particularly, if you can overwrite some of them with the volatility in EM. So, yeah, we're running more conservative. I will say from a fundamental default perspective, I still feel very good about the high yield market. It's just the levels, are just okay. By the way, in our global allocation fund, I'm pretty blown away. If you take the beta of the equity market relative to high yield's held up really well.